Hello and welcome to this edition of All About Your Company. It's a very, very interesting company we are picking today. It's Bajaj Consumer Care, and the reason why we are picking this is because we've seen a very strong and unexpected uptick with regard to both top line and margins, and you can see the reaction on your screen, 20% higher on a Bajaj Consumer as a result of that. What you need to know and how one should look at this company going forward is what we'll try to understand. But of course, we have to look back and try and get a perspective on what the company's already done. The first thing I want to know from today's segment is rural, because that is where the growth has come from this time around. What is driving that rural growth forward? Is it just GST rate cuts? I believe not. It's a combination of factors. It's a little bit of distribution push which they've done, but it's likely a little bit of GST, but I'd want to know whether that number with regard to rural growth is actually sustainable or not. Is that what will drive the company earnings going forward as well? Because it's an important component, of course, in Indian consumption as well. So it's not just going to impact Bajaj Consumer. What they say on ground is going to impact pretty much all players. So that's point number one. Point number two is distribution channel. I'm trying to understand as to how that channel mix plays out and what the growth contributors to new versus existing channel mix is. So they continue to grow their current direct distribution by 10%. That's the goal. They've done the entire full year growth for 2026 FY already at the end of Q3. They have around 6 lakh touch points at this point. Now I'm trying to understand what the growth parameters are on existing versus new, because I believe the existing also has contributed in a significant fashion. So I'm trying to understand on this elevated base, can they continue to grow even on their existing outlets? Because if there is new outlet growth plus existing, that will cause a very strong tailwind. Now the third piece is with regard to price hikes, and price hikes on the Almond Drop hair oil, that's one of their products. I'm trying to understand how much that price hike is. I'm sure that he's not going to give me a number, but maybe a mid-teens kind of price hike could be very, very significant or meaningful, or even if double-digit, could be very, very significant or meaningful. I'm trying to get a sense of that. The fourth piece is with regard to input cost trends, and we've got a trend of the input costs, but I'm trying to understand whether that lowering of input costs and the sharp uptick with regard to gross margins, 800 bips is the uptick YOY on gross margins. Is that sustainable, and what gives them the confidence that that will sustain? Because they've guided for margins going up towards 20 and likely even beyond. So I'm trying to get a sense of what gives them that confidence, and that is on the margin count as well. And the fifth piece is with regard to product diversification. Of course, hair oils contributes around 80% of the revenue, or over 80% of the revenue. Is there value-added products in the sense outside of hair oils, value-added products, and we'll discuss the product lines. Is there a plan to scale that up or ramp that up at a far faster clip, therefore attributing a larger chunk of the revenue mix to them? I'm going to try and understand all of this. But let's start off with what the company does. And it's a Shishir Bajaj Group company, and it's a key FMCG, but moreover, within the personal care segment, and light hair oil category, it's one of the top players in the light hair oil category, which is the non-sticky hair oil, which is a specialized product, and because it's a category leader, therefore it enjoys those advantages of a category leader. So while there are several players in the space, a Marico, a Dabur, an HUL, but in the light hair oil category, it is one of those leaders. So that's the backdrop of this company, and 80% sales from hair oil, and therefore that's something that you want to keep in terms of a perspective. In terms of key products, you can see those on your screen. You've got all of those products. Then you have No Marks, which reduces acne and marks. There's herbal powder, Banjara, which is what they've acquired as a brand. So herbal powders and gels, and ethnic, which is henna and rose water. So they've forayed into those spaces as well, trying to understand whether the mix there goes up as part of the strategy going forward. Let's talk about the business model. They manufacture these products themselves. It's like a typical FMCG company. They also do a little bit of contract manufacturing, which is what the likes of an HUL does, and then they rely on raw material prices. And if raw material prices were to inch upwards, it will obviously cause pressure. Those are the three raw materials key to the company. LLP, which is light liquid paraffin, the prices have gone up sequentially, but for refined mustard oil and copra, in fact copra has come off the highs, so you're still at elevated levels. But for refined mustard oil again, and for copra, there's been that tailwind with regard to giving it margin benefit, at least at this point. I'm trying to understand how price hikes will play out and how margins will play out as a result of all of these factors, and how sustainable is the kind of price cut that we've seen. Distribution strategy. There are broadly two distribution networks that they have: general trade, which is your kirana stores, and then there's modern and e-com, right? And everyone's tilting towards modern and e-com. But general trade is what Project Arohan deals with. They're trying to increase the number of touch points across the country. They currently have 6 lakh touch points. The goal is, as I did mention, to grow it by 10% every year. And they've already done that for FY26 at the end of Q3 itself. So they've achieved that in 9 months. In terms of geography, 95% plus is India at this point. The rest is exports, so very, very heavy reliance on India, of course, and understandably so. It distributes hair oils nationwide, and therefore there's no real gap there. But of course, the number of touch points, there's significant scope for expansion, and that is playing out on the Q3 numbers, which is why you're seeing the reaction on the stock price that you are. Now let's talk about the numbers themselves, and let's break it down. The P&L account, when you're looking at the revenue growth, it's been far from enthusing. It's been just a 3% CAGR over the last 3 to 4 years. But why do I give this a neutral? That's because going forward, the guidance is that they'll do mid-teens. Now, this could be big because when you've got a company at maybe 1,000, 1,100 crore in terms of top line, 3,800 crore in terms of market cap, and in the FMCG personal care space in India, growing at mid-teens, that is something that the investor really looks out for, because growth has been hard to come in an industry like this. And if Bajaj Consumer can deliver that, that's a key positive. And hence, we've been cautious, not been too aggressive, not been too sanguine given the kind of 3-year growth CAGR, and we've given this a neutral. You look at EBITDA margins and EBITDA as well, absolute EBITDA, and it's been largely flat. You know, the kind of pressure or raw material cost pressure that's come in is evident over here. And profitability, therefore, there's been pressure on. Also, one more thing, the effective tax rate of the company is roughly 20%. So we've factored in as part of our estimates in terms of valuations at 25%. So profit after tax will largely be as a component of that. Also, there is no interest, or hardly any depreciation cost as part of the P&L. That's something you want to note. And there's also other income. So a lot of those factors playing out on that P&L number. So that may look elevated versus the EBITDA, but that's the real insight. Now you look at 9-month FY26. Here's where all the numbers are turning around. You're seeing 17% revenue growth, which wasn't seen in the last 3 years, a 50% EBITDA growth, very strong tailwind, and a 34% PAT growth, which you have seen in the 9-month figures. Of course, in Q3 in particular, the figures are even more robust. 31% top line growth, 115% EBITDA growth, a nearly 70 bip expansion in terms of margins from 11.1% to 18.3%. And then, sorry, not a 70, in fact, a 700 bip, I stand corrected in terms of margins, and profitability has surged. It's nearly doubled. And therefore, you've got very, very sharp numbers in terms of your Q3 performance. Now, let's analyze margins. Margins have been choppy, and it is largely dependent on raw material prices. That's why we've given this a neutral. So while there's margin tailwind, I'm trying to understand what gives the management the confidence to guide for a 20% margin in an environment where raw material costs are benign. Because if it were to turn the cycle, raw material cost cycle, you could well see again pressure on margin. So what's giving them that confidence to guide for a 20% EBITDA? Now let's talk about cash flow. And cash flow also has been a little choppy. Working capital requirements have kept that cash flow number slightly on the muted side. Also, they make acquisitions on they've made a couple of acquisitions, including the likes of Banjara, which I spoke about. So they venture into new products, and that's why that's the impact of that you'll see on cash flow. Again, we've given this a neutral. They do a lot of buybacks as well. They give out dividends as well. It's a cash-rich company. The balance sheet, if you did see, if you did have the opportunity to see, you saw that there was a very low debt. Let's pull out the balance sheet. Very low debt. The book value is at 750 crore at the end of FY25. And at the end of H1 FY26, it's at around 645 crores. So buybacks have been a regular feature. You've got cash and bank balances of around 60 crore still sitting in the balance sheet. And you have a borrowing number which is very, very low for the kind of market cap it has. And therefore, no concerns with regard to where the balance sheet is concerned. Primed to grow very clearly with regard to the balance sheet support. Let's talk about the return ratios. And this is where it starts getting very interesting. You look at the kind of return ratios across cycles, they've been able to do 20% plus. Even FY25, which was a tough year, they've done 19% ROCE, which is extremely strong for a company. And you know, for an Indian company to have 15% plus is typically very strong. Now, you will have some of the consumer companies which have a far stronger ROCE, but this one is at nearly 20 times earnings, and therefore this looks very, very attractive. Let's talk about the shareholding. And of course, buybacks, and as a result of that, you've seen promoter shareholding go up. FIs have been holders, but they've sold some stake. DIs have held on in some form, and then you have the public. We've given this a thumbs up only because it's a Bajaj Group company, one, and promoter ownership as a percentage has gone up because buybacks have been a regular feature. So what you've seen is therefore promoter ownership inch upwards, and therefore the thumbs up with regard to the shareholding pattern. Let's talk about the analyst view, and 11 analysts track it in all. 9 buy calls, 2 hold calls with an upside potential of 24%. That's the 12-month upside potential which which analyst community is seeing, and therefore that's something you want to keep your eye out on. The last piece is valuations. The 1-year forward PE is 21 times. All right, you want to note this: 21 times 1 year forward for a consumer company, even now after the 20% rally. 5-year average is 17 times, and the 1 year forward of competitors, wait and watch for that. That's how it stacks up. So essentially, it's Imami, which is at 25 times, which is a single-digit growth. When you're looking at Dabur and Marico, you look at the valuations versus a Bajaj Consumer. That's why the interest in this one. That's why the analyst community seems to like this over some of the others, because there is that valuation comfort which is available. So that's how we look at this. Let's go across. We have Mr. Naveen Pandey, Managing Director at Bajaj Consumer Care, joining us to give us a perspective on how to look at this going forward. Naveen, great having you. Let me start off by understanding from you the rural piece. I believe that's where your growth spurt has come from. Talk to us about the factors outside of GST maybe that is leading to that spurt. Give us a sense on the sustainability of that. So why and how sustainable?
Thank you, Harsha, for having me on the show. It's a pleasure to be here.
Great having you. My
In
pleasure.
terms of the growth profile and the contour, if you were to understand, what you will see in our commentary is that this year, this quarter specifically, the growth has been fairly broad-based for us. Urban has performed well, within urban, retail has performed well, wholesale has performed well, rural has really performed well, and overall organized trade has continued to do well. But the big delta, if you were to look at from the previous sequential quarter to this quarter for us, has been rural. And that is a culmination of 2-3 factors for us. First, over the last few quarters, we were doing a significant transformation in rural under the Project R1, wherein we were kind of reorganizing our rural distribution and making it more direct in nature. And that's an exercise which was being carried out for quite a few quarters and has kind of, we've combined and finished our top 8 states, and we have moved ahead, and that is resulting into an upside. What we also see is that over the last few quarters, we have really got our focus on our main brand, the name on the door, Almond Drop Hair Oil. And our advertising spends and our focus on that brand has really increased. Even in this quarter, our advertising spends overall are up by around 37%, and we are really investing behind the brand, and on the brand, the spends are even higher. And that focus and that increased level of advertising, both on traditional media as well as on the digital, has really, created a traction for us in the consumers space. And overall, I believe the consumption environment, with the recent changes in GST, etc., has also seen an upswing. And all of these kind of have come together to fuel our performance in this quarter.
Talk to us about that first piece you spoke about, the distribution strategy which has changed under Arohan, which is your project with regard to distribution in rural. You're currently at roughly 6 lakh touch points. You go up by 10% every year. What's the scope like? For how long can you continue to do this?
So if you look at some of the larger industry peers who operate, with similar product profiles like ours, or a slightly more wider portfolio, are doing anywhere between 1 to 1.2 million outlets, which is nearly double of our size in terms of their direct reach. I believe we can at least cover 50% of this gap over the course of the next 3 to 4 years. And hence the idea of trying to make up 10% year on year so that we are able to cover up that gap of 50%. We've already covered the number which we had planned for this year, within the first 3 quarters. We will consolidate, drive efficiency, and keep on doing this for the next few years back to back.
So you have a virtual tailwind of the next maybe 7 years at the very least, where you get to your competitors and you can continue to grow at 10%. Talk to us about what that does to your distribution cost. Does it go up significantly or not as much?
No, so distribution cost will, by and large, remain range bound because the growth which will come in, on back of both the core products as well as the new portfolio. And as long as we are able to keep our revenue growth in the double digits, I think the upside and the efficiency will keep on balancing the enhanced cost numbers. So I think the trick there is to ensure a more stable trend of double-digit revenues, and as we do that, that will work well for us.
And your existing channel or your existing, infra with regard to distribution, let's exclude the new or the added centers or touch points. Talk to us about the existing touch points. Is there organic growth seen there itself? And then what do the new touch points add in terms of growth? I'm trying to understand that going forward, you'll add probably 2 to 3 lakh touch points over the next maybe 3 to 4 years. I'm trying to understand how much of the revenue contribution of double-digit growth that you've guided for comes from new versus existing.
So, Harsha, in the consumer business, most of our distribution is weighted. So the new set of outlets don't add to commensurate revenue. They always add to lesser than commensurate amount of revenue. And some of it is actually substituting wholesale revenue into direct revenue. So it's not a really directional straight upside which you get out of the new outlets, and hence for a good growth to happen, the core outlets have to perform well, which have performed well in our case.
So what's the core outlet growth, if you can quantify that in this quarter, as well as what's the anticipation maybe over the next 2 to 3 years?
So it's slightly lesser than our overall growth rate is what I can call it out. And over the medium term perspective, we would want to aspire to maintain a double-digit growth rate in these outlets, wherein we believe that we can get our core Almond Drop to grow high single digits, and the balance growth can come in from the new innovation which we put into these outlets.
On the Almond Drop, what is the volume growth that you've clocked, and are there price increases in the offing?
So we've clocked a double-digit volume growth, and that's very, very robust and has come after a very long time. Again, as I explained, it has come on back of a lot of consumer work, a lot of advertising action which we've taken over the past few quarters, which have culminated into us getting to this stage wherein the growths have climbed up in terms of volume to a double digit, including registering a very strong volume market share gain. Now, I believe as we look forward, what we see is that we would want to maintain the kind of growth offering which we have on a volume basis. It might not be double digit, but at least mid single digit on a long to medium term basis is something which we would aspire to maintain. And as I said, high single digit revenue growth. At this point of time, what we have is a combination of three actions, which is pricing, a certain amount of mix change, and certain revenue management levers, which three combined put together are close to adding more than 10% to the volume to basically deliver the revenue. So into teens. So the cumulative impact of pricing, revenue mix, and product mix and revenue management is delivering a mid-teen kind of a delta.
I'll switch focus to margins. You've guided on your con call for margins of at least the aspirational margin to be more than 20%. What gives you the confidence that if raw material prices were to get choppy, that you'll continue to deliver that?
See, if you look at it, this same quarter last year, we were at close to 12% operating margin. And I think where we sit today is, at the quarter, for not for the 9-month period, but for the quarter at 18.5% margin. So there has been a significant change which has happened over the past 4 quarters in terms of the margin improvement already to us. So that's a massive change. And I think that has happened at a very, very sharp, accelerated pace. Having realized most of the low-hanging opportunities to fix margin, I think the subsequent delta will come slowly and gradually. But we are confident that if we continue on our path, which we've set forward, we should definitely aspire for a operating margin in the 20s.
And will it be 100 bips every year? Is that the aspiration? Because you're trying to make this more structural, and therefore would 100 bips be the commensurate kind of margin accretion every year?
Yes, I think that would be a fair way to put it. Though what we also always need to remember in terms of margin accretion is not a straight line. It is a result of certain strategic actions you take, and hence it happens in spurts and then periods of range-bounded performance. So with that caveat in mind, yes, we will continue to aspire for improvement over a period of time.
Is there a strategy to diversify product as you continue to expand your geographic reach or your geographic penetration, if I can call it? Are you also pushing out other products, and are they growing at a faster clip? Is the mix going to tilt more, or is there going to be less reliance on hair oil versus other products?
So our, I think, core job right now to improve the performance of the company. I think the first and the most important thing for us was to ensure the health of Almond Drop. Having reached where we are, I feel extremely confident about that today, and hence the work on enhancing and fast tracking diversification of the company will continue. Our endeavor would be to build second, third, and fourth pillar for the organization, like today Almond Drop is. And we will take calculated bets behind certain brands and certain opportunities wherein we can create sizable brands out of them over the next 3 to 4 years. So it will be a set of calculated calls which we will take over a period to create not just one Almond Drop as a big leg, but 3 or 4 very, very strong legs for the organization.
And Naveen, give us a sense on your ROC numbers and your capital allocation strategy. Is the aspiration to get to 25% again ROC? How quickly do you get there? That's point number one. Point number two, of course, right now you're in a benign cost cycle environment, but how are you placed against competitors in terms of price? Do you believe that price competitiveness is very, very sharp? My last question, and therefore I'm squeezing two together.
So Harsha, first on the return on capital, what you would see is that our business is fairly capital efficient, and we've been maintaining it that way. Our last couple of years has seen a slightly downward trajectory on the returns, primarily because our overall operating margins had reduced, and hence we were not generating the kind of PAT which we would have wanted to. As that corrects, you will start seeing a very significant improvement into the ROCE numbers. And if you start calculating it by quarter, you can automatically see where we are likely to end up. The second question, can you just repeat that once again for me?
Yes, versus competitors, the pricing, is there larger comfort and therefore raw material prices can get passed through?
So see, we operate at the premium end of the spectrum, Akshay. I don't think so. We are price warriors in the segment, nor do we intend to become one. We will concentrate on building our brand, offering a fantastic, superior product to the consumer. And if there are cost increases, our consumer would prefer to us to maintain the quality of the product rather than downgrade product to save costs. So those are some of the principles. We will not dilute the product or the equity of the product. We will continue to invest behind the product, and we will continue to play in the branded premium segment rather than play in the value of the economy segment. Rest, inflation and these things are cyclical in our industry. We will take the right call, given the long-term health of the organization and the consumer in mind, as and when we need to take those calls.
Naveen, it's been a fantastic conversation. We've got great insights from you, and many congratulations on a very, very strong delivery this quarter. Hopefully it sustains going forward as well. And viewers, hopefully this has been great perspective for you as well. Thanks, Naveen, for joining us. All the time we have, unfortunately, on this edition of the show. Thank you so much for watching. Stay tuned. More action on the other side.